Welcome to the New Barbarians podcast. I'm Bill Mann.
And I'm Mark Connors. We're here to deliver insights on how current market events impact the traditional investment portfolios of stocks and bonds that Bill and I traded on Wall Street. Today, we see digital assets as the next frontier for finance and investment.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So instead of Mike Millikan's innovation on debt financing with junk bonds, today's barbarians at the gate are changing the landscape almost daily across regulation, legislation, and finance.
So hit the subscribe button and let's cut through the noise together. Hello, everyone. This is episode 38 of the New Barbarians podcast. Today is Monday, October 6th, 2025. The podcast will hit platforms tomorrow morning. Today, we're joined by Bartt Kellermann. Say hello, Bart.
Hi.
Hey, Bart. Thanks for joining us, my friend.
Pleasure to be here.
We got a lot to talk about, as Bill will tell us.
I'm going to give a few notes about recent events in Factorland, and then I'll pass it off to Mark, and then we'll get into the discussion with Bart. Wednesday's government shutdown delayed the release of the BLS report. ADP employment report did surprise to the downside, but
is that
some
good
of
or
this
bad, Bill? Is down. Is that
down's usually good for Bitcoin and risk asset investors. But, I think part of the point here is the missing data complicates the Fed's decision making. And maybe we can actually talk about that. I don't know if everything gets shut down or if, the Fed can still, do critically important work. But who knows?
They can still print the money. No problem. They'll be buying bonds, injecting cash.
I have a feeling you're right. In Asia ex-Japan, the delay of Trump's proposed tariffs on brand name drug imports originally set for October 1st spurred a rally in growth stocks. So we saw 3.75, plus 3 sigma events and sales growth, earnings revision, EPS growth, dividend yield. So value sold off. And in the U.S., we had a rally. The rally was concentrated in liquid names, volatility, and short interest, and then sensitivity to inflation and reversal were down. Again, those were all like 3 sigma events, so very large, statistically significant moves with all the news. And I will let you take it over from there, Mark.
Yeah, markets really don't like uncertainty, and not having data for a Fed that considers themselves data dependent, although they go between deterministic and data dependent, depending on the shifting economic winds. And we wrote about that, Bart, in something we called the third mandate, which was the hidden mandate of the Fed, which is proper market functioning when things go sideways, like we saw in September of 2019, when we had the repo break and people couldn't fund, when we saw banks fail. The Fed throws all mandates to the wind and they come to the rescue with bailouts and new programs like BTFP or that repo function. So I mentioned that, Bill, because you said it doesn't matter if the Fed doesn't have data. It really doesn't matter. If the banks need help, they're going to print money. And when it comes up to their next meeting, they're going to, right now, I think, follow and err on the side of employment. That was their leaning, as opposed to inflation. So I think that it doesn't matter for the data standpoint. The markets will not like it, and the markets will do exactly what they're doing. And let's go to that quick review right now. So on this screen, we have our regular scorecard, Bart. We try to show the same thing in only 2 frames, month to date and then year to date, to kind of do a, comparison. And we're looking at 10 assets. We're looking at Bitcoin and gold, the historical and emergent, I think, safe haven, but Bitcoin's a little more complicated than that. EFA, which is a focus today, which is global ex-US and Canada. That's equities. And then we have the dollar, NASDAQ, S&P, the long-term treasury, the medium treasury, the 10-year. These are ETFs, so they include dividends, coupon flow. US, high yield, and then oil. So over $400 trillion of assets here with corporate credit and sovereign credit represented. Clear departure on the equity side. Equities are down. And I'm just going to go to this slide, first of all. Secondly, This is looking at Magnificent Seven in September. So they had a huge run. Here's the index as a whole. It's an ETF put out, Mag 7, and it was up 8%, which almost doubled the year to date. So September was a big global mega cap tech rally globally. And the US obviously dominates that, but not so much this month. You see Mag 7 are basically down in general, and you have Bitcoin, leading the charge here. So let's go back to global assets. EFA is up 28%. 10% of that comes from this little guy here, the dollar being down, because these are dollar denominated assets. So these ETFs from Europe and Japan, Nikkei up 5% today, they're up because the dollar's down. That's a big deal and very important for the US. And we mention it because the dollar is actually up in October. So we're having a reversal of what we've seen in patterns. Let's keep going here. Here's the currency picture. So in October month to date, just 3 days through Friday, not counting today's gains or over the weekend, reversing what we saw year to date. So this was by design again through the tariffs, debase the dollar, make exports easy, even though Trump says he wants to have a strong dollar, not in a trade weighted basket. He doesn't at all. And so let's go back to the yen. The yen is down 1.7% in the first 3 days, down more today because the new prime minister, again, I think it's the third or fourth since 2020, which is getting to be a post-World War II record as far as turnover of PMs, reversing the year-to-date improvement in the yen, which the Bank of Japan wanted because the yen was flirting with 150, 160, or through 150, flirting with 160, and really losing control as a stable currency, which is not constructive. So the balancing act is being lost, and you're seeing it in these interim rotations, which I think won't stand the test of time. I'm going to throw a teaser out here, guys. I'm not going to go through this, but this is one of my most telling graphs, I think, which offline, Bart, you and I were talking about, or I was, you were indulging me a little bit with listening to 1970s trivia music for 200, please, Alex. We're talking about how the political landscape is mirroring that of the 70s, which means tumultuous turnover. And with the French prime minister out, in very short fashion, what we're looking at here is post-World War II dynamics, the setup from a demographic and fertility standpoint. You're looking at life expectancy for our podcasters on Spotify. It'll be in the show notes. I suggest you click this link. It'll explain why there's pressure in developed countries, why you're seeing governments change at levels that we haven't seen since pre-World War II. Life expectancy was bifurcated post-World War II in 1960. You had developed nations like Japan and the US somewhere around 70 years old, and the rest of, say, developed Europe. But in Asia, including China and India, it was somewhere between 33 years and the majority less than 50. Energy, this is all related to economics and technology and health. But when you click this button, which I'm not going to do in the graphics, I'm not going to torture our Spotify listeners, you'll see this grouping in Asia, China, India, Malaysia, sub-Saharan Africa, move from a sort of average 40-year life expectancy, all having 6 live births per woman per lifetime, all gravitate towards where the developed market is. And the whole world has gone to a longer life expectancy, fewer children. And the kicker is, unfortunately, lower growth and more debt. And that's why, back to our 70s song, they started to fight when the money got tight and they just couldn't count on the tears. Billy Joel, basically, this is the anthem for developed markets right now, is that the money's gotten tight and they're starting to fight at the polls rather, and the political upheavals are not constructive. And that's why you're seeing gold bid, you're seeing Bitcoin engaged as another nonpartisan asset distributed. Not saying that it is a global reserve by any stretch, but it has gone from speculative asset and a curiosity to now, I think, being adopted not just by the DATs part, like you mentioned, but by companies and corporations as a small sort of 0 to 3%, 1 to 3% holding on adoption. So that's the picture. The markets are reflecting what I think is a persistent and will be continuing disruption in developed markets because of immigration, because of economics, which is giving rise to discord and you see the voting in the markets. So that's the backdrop. Excuse me. This is where Bill Mann comes in and Bart. The handoff to you guys from the global macro to showing how the reason why folks like you and active managers are around, because in times of uncertainty, people want to know if active management matters. So I'm going to leave this chart for you two to mull over about what we've seen in the past year, the past month, and just in the first 3 days of October, and whether or not there's any information here and what you guys make of it.
Thanks, Mark. And so the chart you're referring to is the life
Oh,
expectancy one or
excuse me.
the
Thank you. So I wouldn't put life expectancy and birthing rates on you guys right now. So let me get back to
that's
the
fine.
screen.
We can debate that as well.
Here, I'm
But
talking more about the factors, Bill.
got it.
But yeah, no, if you guys want to talk about that, replacement rate in Japan being negative, just how they need immigrants, and it's now from 1% to 4% of the workforce in Japan is non-native born workers because they're just losing people. By 2030, there'll be 1 million of the workers will be non-native born because of the declining birth rate, which is now a net negative.
Yeah, but that's always been a problem in Japan. I mean, I think at one point they actually brought. It's really fascinating. If you go to Tokyo, every once in a while you run into Brazilians because there was a point in time where they didn't have enough workers and they imported a boatload of Brazilians, and then they closed the doors again, and it became very difficult to get citizenship in Japan. But now I guess they've got to open those doors once again, and it'll be interesting where they source those people from. I mean, where are they going to get them? And what are they going to do for the economy? I'm fascinated to see how the Japanese are going to approach that, because basically the Europeans have just opened the floodgates, and anybody who shows up at the shores gets basically a place to live, healthcare, whatever, and in many instances don't even have to work, but they're just populating Europe with a whole different set of cultures and values. And it's going to be interesting how I think, and they're doing that in response to the lower birth rates and people living longer. They need a younger set of people to drive their economy. But I think it's also having a negative effect on people, as you see the marches in the streets over the weekends in London, in Paris, trying to maintain their own culture. And it's getting very argumentative. And I think when people see that, maybe they don't have the incentive to work as hard as they did before. And if they're retiring and you didn't make enough money, you're right, that Billy Joel song comes in, very appropriately.
Yeah.
What do you think,
Yep.
Bill?
So I guess I saw some reversals of year to date versus October, and it seems like there is some risk on. And usually that means people are betting that there's going to be more monetary stimulus. And then, of course, now we have a bifurcation in the US versus elsewhere and Asia in particular. So I think it's a great market for stock pickers. And, quants can follow the trends and typically they're going to be betting on all of these different factors long short, but if you're able to tactically position your portfolio for whatever regime we're in, crazy markets are a good time to make money. So I think that macro investors in particular, discretionary managers will outperform quants. I don't know how many government shutdowns we can model now. There are many, interestingly, but each one's going to be a little bit different, at least in terms of global stock performance and sectors and styles. And this time we have this AI boom. So I think it's a great time for active managers. The passive versus active rally is probably not over by any stretch.
Mhm.
I think there's always going to be a lot of portfolio allocation for passive strategies. Like everyone should bet on betas, but yeah, I think it's a very good time for stock pickers this year in particular. In the first quarter, we saw that all the outlooks were wrong. So even if you were just following consensus, you weren't going to do well. So digging in deep, noticing these big changes, thinking about what it means for the next like 3, 6, 12 months is a great way to make money and actively manage alpha for your investors.
One of the French investment banks came out with a report on performance, and they said I think it was over the last, I'm not sure, the last 3 months, the multi-strats have had the highest performance, and followed by the quants. And there was a article that I posted, I think last weekend, on AQR's multi-strat fund being up 15% and change. And I think there's a lot of money transitioning out of the private equity funds and the credit funds because of the lockups. People want their money back because they were supposed to have, basically, how those private equity funds work. They get liquidity, and then you're basically, you get your money back. But for some reason, a lot of the companies aren't doing that well. People's money, they're getting capital calls, they're not getting their money back. So what money is coming back is going into shorter term. And I'm finding a lot of the quant funds now have more liberal terms. You have monthly liquidity, and you have lower management fees, which is usually, not the case. So the liquidity issue, they're hitting that straight on. Like, look, you can go into my fund and you'll have monthly liquidity. So I'm seeing that happening a lot. And that's what we're going to talk a little bit about during the Battle of the Quants. And the other thing is, we're getting a lot of unsolicited, we do a lot of marketing, but there's a lot of unsolicited initiatives coming from people saying, hey, are you hosting your event? Can we get access? Can we speak at your event? Can we promote our fund at your event? Can we see who's pitching at your event? We have an unprecedented number of investors that want to speak and talk about their strategy. So that's sort of a reflection, I think, of the market, that there's more capital coming in. There are more funds that are launching that we're seeing, and there's just more interest in general. And we're very excited. And it's still a month away. And so I think quants are doing well right now.
Yeah. And Bill, and jumping in on what Bart just said about the private equity. Oh my God. If you want to talk about a reversal, you look at any endowment and where they're taking hits and still marks. And those marks, as we all know, are not accurate. We saw sales out of Harvard approaching 60% discounts that Bill Ackman talked about a few months ago. I think actually even in May and June is when they first surfaced. And I think back to interest rates, it was great to have private equity when we were grooving from 3% to 0, and then pinned there. But once we had rate volatility, valuations dropped like a rock, and appetite went away for illiquid investments, as you just mentioned, Bart. So I can understand the interest in, and I want to hear more about the Battle of the Quants, because I think you've been doing it for more than a few years. Why it's there? When there's interest rate volatility, all valuations become volatile. Quants love variability because they have models to extract and arb. You know better than I do. I just sort of watch from the sidelines in that game. And I think, given what we saw with that mini rotation just in the first few days of October, we have never been in a period where we have had this kind of monetary disparity. We don't have everyone rowing in the same direction. When everyone's going up and down with their currencies, then the debasement's uniform, and there's no recognition in the currency rates. Either debts are going up or down, or rates are going up and down within each region, and there's no differentiation. Right now, you have people like Trump saying, I'm going to debase. And then Japan said, I'm going to raise rates because I have to protect my currency. And then the new PM comes in about leadership and says, I'm going to reverse it, and I'm going to let my currency run because I want to stay in office, and I'm going to ease fiscally and print money. So what I mean by all that is we don't have a uniform approach, and we're going to have rate volatility. I think everybody will eventually print, but until then, it is a fertile ground for someone with a sharp tools in order to extract alpha as things change across the globe.
The other thing that I see, one of the things that we adopted at the Battle of Quants is we brought in a whole data component. Quants really operate on data. There was a time when everybody talked about strategies. I think, Bill, we talked about this the other day. You start with a strategy and then you find the data to run that strategy. It's now reversed. It's almost as if people say, okay, we can get really high quality data. Let's formulate a quant strategy around that data. And if you look at the data world, it's doubling every couple of years. The amount of data that's coming out there, and alternative data, meaning data between when the government comes out and does its announcements. Well, there's 1,000 different resources in order to game the system, if you will, or find intermediary data sources.
Okay. Between both of you, I have many things to address there, and I'll try and be brief. I think on the private equity venture capital side, it is interesting to note that there are sales taking place because, if there aren't sales in an asset, typically you're not going to market to market, at least to the extent that it reflects reality. And with super illiquid things like private equity, I think there's always been a benefit with mark to market. But when there are sales and they're at serious deep discounts, that's going to mean these entities that, don't care as much about accounting typically or tax will need to market. And that's not good for those illiquid industries. And, I think Cliff Asness has always said that venture capital and private equity are like leveraged bets on beta anyway. Like if you're betting on venture capital, you're betting on tech, et cetera, but you don't have to mark to market. And I personally do believe that everyone should have a small allocation to certain asset classes like that because it is a different animal. Like if you want the emerging company for in 5-10 years, like that's the way to do it. But it's not for everyone. And I think a lot of those endowments have allocated way too much, and that's why they're
40%.
selling at a
Yeah.
discount. So
They're as high as 40% at some of the, when you factor in venture, private, not even alternatives, but just venture and private, Bill. Those are liquids, and that's why they're getting their face ripped off, and they're celebrating all the gains prior to 2022 and how many scholarships they've given, and they're really quiet right now about it.
right. So rather than criticize the imprudent managers at the endowments, I think that sounds
You mean
like
our clients that we're trying to speak to?
that sounds like a super high allocation.
Yeah.
So, and then to respond to a few of Bart's points, I'll actually properly introduce him. So, Bart is the founder and CEO of Global Capital Acquisition and the creator of Battle of the Quants. And as he mentioned, that has been around for about 20 years, and we can get into that a little bit more. And Bart, if you want to just tell us a little bit about your journey. My notes say your early career at IBM, product innovation and media broadcast technology, and then I guess you launched Global Capital Acquisition in 2002, and then Battle of the Quants. So, what have you been up to for the last 23 years? Unfortunately, I'm not sure if my budget can afford the trip to London for the next one, but yeah, and I'd like to ask you about like for the date on that one, and we'll put this all in the show notes because I think it is very much in our listeners' wheelhouse to find out about these things and hopefully attend. And I do want to respond now on a few things you brought up. So data is an interesting nuance to quantitative investing. So 10 years ago, I think companies like my former employer were at the forefront of data. So at the time, it was all data and geo positioning and retail data in particular was a huge thing, and that was a differentiator, right? Being able to figure out how to onboard and ingest these all data unstructured data sets was a competitive advantage. And then, my former employer did have a team that was only dedicated to finding new data. And then there were companies that saw that and took advantage of that. So now there are what I'll call aggregators that are very good at, surfacing new data. And if you're a new data provider, you probably go straight to them in order to help you basically market your data. And so I do think that the cost of data has come down quite a bit. There are, innovative companies that are helping people onboard and ingest and analyze data. 10 years ago, there were not. And I think even, the classic econometricians and in places like AQR are adopting more data analysis. And rather than call it data mining, now we're calling it pattern recognition. And that means it's okay to look at a bunch of data, find patterns in it that help you predict certain things that you want to predict, such as stock prices, and then, figure out what the econometric thesis is after you've done that. So I'm a pretty big believer in machine learning. I wasn't always. AI is even different in a way, especially in generative AI, but it's very good at, I think, coming up with a hypothesis and a way to prove it after the fact. So again, this pattern recognition or data mining exercise is, I think increasingly a necessary tool in the toolkit. But over the years, my thinking about that has evolved quite a bit. And then it's interesting that you brought up emerging managers, because I also believe that the cost to market has come down significantly. 10 years ago, when I first tackled unstructured data, it was, on-prem machines. So you'd have to have server farms that just to process all this data. Now, I can do it from my home office and a cloud server. So I think costs have come down. Access has become a lot easier. Machine learning libraries are freely available, open source. So, it's basically free with one line of code. It used to mean thousands of lines of code. So I definitely believe that the emerging manager space is probably, better than ever in terms of the quant complex. I think that there are advantages to actually starting up now, because even though the really large places do have the budget, they also have the tech debt, that they've built up over the years. So I think they'll always stay at the forefront because they can afford it. But a emerging quant manager can, set up a pretty good competitive data analysis platform quickly, and then, augment it whenever they need to, because they won't be, running so many different models on their old data and data pipelines and just general tech debt that they've built up.
So Bart, our audience is bifurcated when we look at our data on the New Barbarians podcast. It tends to be that younger person who hasn't set their career and is sort of saying things are changing. Where the hell can I go? And they're looking for places to apply their skills, because, as Bill said, a lot of firms are jammed because they have tech debt and they're not really innovating. They're not adding. That seems to be the narrative in the job market at a high level, that there's not much firing, but there's very little hiring. And then we have the older folks who are running businesses or looking to make a career change. When you look at your audience, is there a spot for that younger part of our cohort who looks at us, who is saying, I have the skills, but I'm not really getting a lot of callbacks? Like, why would the Quant conference or the folks that are there be wanting to connect with a hungry, young, skill-laden audience?
I would maybe call him the portfolio research king or something. He's very very much advanced machine learning and portfolio construction, and big fan of his. And that's right. Yeah. So I think he basically created hierarchical risk parity, or at least defined it. And now, causality becomes increasingly important when you're dealing with machine learning, artificial intelligence, and what's the new field, explainable AI, and it's kind of beyond just feature importance. It's actually pretty cool to, again, this is bringing econometrics into this pattern recognition, data and analysis, and in portfolio construction. It's even harder to see exactly where all of the value is coming from. Since you mentioned formulas, tomorrow I'm going to be at the Wolf Research Conference tomorrow and Wednesday, and it's interesting. You also mentioned that it's quant conference season. I was at the Cornell conference a couple of weeks ago that Rebellion Research put on. So shout out to Alex Fleiss, another former visitor to this podcast. And I think It's actually pretty interesting. If you're in New York, you do see several of the same people show up each of the conferences, and I don't want to call them out by name or anything like that because we want to bring them on to this podcast, and I don't want to insult them in any way, but um I know almost all of the speakers at a typical quant conference in New York. So I'm actually looking forward to joining yours because it's going to bring some of the new managers and the emerging managers. And it sounds like it's a great place for emerging managers to meet allocators, for students to, volunteer and try and meet people. I've become a huge believer in networking, which, I kid around. If you looked at my LinkedIn profile for the first 15 years that I had it, I probably had, 10, 20 posts over that whole time. So, maybe one a year. Growth in my network was almost non-existent, as friends and people like that. And now it's crazy. It looks like I'm a influencer or something like that. And so I do encourage, new listeners and students and people that are trying to figure out a way to break in. It is competitive and it's hard, but networking and reaching out, hopefully listening to podcasts like this, you sort of through osmosis at the very least get to pick up on some things. And I've had students reach out to me after conferences that are put on at universities, and you know we are happy to help people build their network. And you're obviously the leader in this within the quant space, Bart. So yeah, thank you for doing that for all these years. I'm sure there are, many quants who have, built their careers as a result of some of what you've done. So that's really cool. I will say that the people I've worked with that have been around for 20 plus years would have a visceral reaction if they heard someone say that they used to sit around and do Python. It was not Python. It was the worst of the worst. And Python has made everyone's life so much better. You used to have to pay for a statistical software package, which had its own unique syntax. And then after you did your statistical research, you'd have to implement it in some other code such as Perl or, Fortran. And I think that everyone's lives have become a lot better. The fact that Python is even was something people mention and expect you to know what it means is a huge advancement in the space. And I use LLMs to generate Python code, and like I said earlier, I'm running machine learning algorithms with one line. The barriers to entry have come down quite a bit, and I think also I've worked with some of them, and you observe them. Quants were second class citizens at investment banks 20 years ago. You had your desk quant who was delivering value in analytics and sometimes automating things like Excel spreadsheets. But I almost look at the credit crisis as being a pretty big turning point when like Cliff Asness AQR kind of emerged and started showing up on the covers of magazines and things like that, because they were outperforming the market. And ultimately, that's what everyone cares about. And quants have consistently delivered alpha for a very long time. And so, they kind of proved themselves. And the fact that it's a cool place to be now is just hilarious to me because, yeah, the original quants I worked with were, I think they were super nice and happy to talk to you because no one ever talked to them before.
That's a
So,
good point, Bill.
you know it's and thank you also for bringing up Terminator. We almost need to put a mark down in the show notes because we clipped the Terminator quotes. It's probably the fourth time since we've been doing the podcast where Terminator is prominently showcased, and there's a good reason for it, right? So automation, AI, humans versus machines, all of these concepts are much, much more at the forefront of everyone's imagination now. But yeah, like as we wrap up for today, thank you very much for joining us. But can you maybe plug whatever you want to, and we'll leave the last 5 minutes for some back and forth about whatever you want to talk about, Bart.
Mining in Mars using SpaceX could help reduce emissions on the Earth. So that's one way to reduce gas house emissions, I guess, if you change houses. And that's what Elon's trying to do.
I would also add that not knowing ESG when you're in Europe is problematic, because I think
Makes
that's
for
where
tough dinner parties, I imagine, for that
that's
guy.
certainly much more popular in Europe than in the US.
Yep.
So I guess we can call that a day, and we will.
Great guest, Bill, man. Bart has been around with that conference, and I love what he does. He says it's about people at the Quant, which isn't a first go-to for many when they hear quantitative finance. It's about finding the right people with the right tools.
Cool. Well, see you next week.
All right. Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support.